Hey Cosmic community, welcome back to We Are Cosmic, where we break down everything happening in the world of cryptocurrency in a simple, easy to understand way. If you're new here, don't forget to hit that subscribe button because we make complex crypto news, market moves, and regulatory updates understandable for everyone, whether you're a beginner or a seasoned investor. Today, we have a major topic on our hands, the Clarity Act. This bill was supposed to finally give the U.S. crypto industry some clear regulations, but things have taken a dramatic turn. Trust me, you'll want to stay tuned because this could impact every crypto investor in the United States. So here's the headline. The Clarity Act has been delayed, and the reasons are big, messy, and involve some of the biggest names in crypto. We've got Coinbase CEO Brian Armstrong, Ripple CEO Brad Garlinghouse, and even senators speaking live from Capitol Hill weighing in. The bill was scheduled for its first vote in the Senate, but it got postponed after heavy pushback from the crypto industry and financial institutions. Why? Because, as Brian Armstrong said, the bill was materially worse than the status quo. In simple terms, the proposed law would have actually made things harder for crypto businesses and users rather than providing the clarity everyone was hoping for. Let's break this down. The Clarity Act was meant to define who regulates what in crypto, whether the SEC or the CFTC would have oversight over different types of digital assets. Crypto companies, including Coinbase, wanted the CFTC to take the lead because they felt it would provide more flexibility and better understanding of the technology. But the bill's draft had several issues. It limited how crypto exchanges could reward users, restricted certain DeFi activities, and even hampered tokenized real-world assets from growing within the U.S. These are huge limitations, especially when other countries like China are moving forward with interest-bearing digital currencies. Here's why this matters for you, the investor. Imagine you're earning 0.01% interest on your bank savings, but an exchange could give you 3% on your stablecoins. Naturally, you'd want to put your money where it grows. The Clarity Act, as it was written, essentially stopped crypto companies from offering competitive yields, which directly benefits banks while limiting opportunities for crypto users. This is where things get political. Senators from both parties, bank lobbyists, and crypto leaders are all negotiating. But the tension is high because banks want to protect their deposits, while crypto companies want to innovate and offer better returns to users. Brad Garlinghouse, Ripple's CEO, has also commented on the situation from Switzerland. He recognizes Coinbase's concerns and believes that the rest of the industry is trying to work constructively, but he admits this is a messy and complicated process. The public reaction on social platforms has been overwhelmingly negative because retail investors stand to lose the most if restrictive measures pass. And this isn't just about money, it's about the future of crypto in the United States. So, Cosmic family, here's the big picture. The Clarity Act was meant to clarify the rules, but instead it has exposed how regulatory capture could stifle innovation. Big banks are lobbying to protect their profits, while crypto companies are fighting to maintain fair competition. This is why Coinbase pulled its support at the 11th hour and why the Senate markup was postponed. What happens next is still uncertain, and this could take months to resolve. Stick around because in the next parts, we'll dive deeper into how banks are trying to influence the bill, what specific provisions are dangerous for crypto users, and why this could reshape the future of DeFi, stablecoins, and tokenized assets in the U.S. Trust me, this is critical information if you are invested in crypto or even just curious about how the U.S. is handling the digital finance revolution. Before we move forward, let me ask you, what do you think about the Clarity Act delay? Do you believe regulators are protecting investors or protecting big banks? Drop your thoughts in the comments because I read every single one and your opinion matters in this community. Let's dive deeper into the specific reasons why Coinbase pulled its support and how this bill could impact the broader crypto ecosystem. This is where the real tension begins, between innovation and protectionism. So here's the story. Coinbase CEO Brian Armstrong took a bold step by announcing that Coinbase cannot support the current draft of the Clarity Act. Why? Because the draft bill, while marketed as clarity, actually imposed serious limitations on crypto companies and users. Armstrong called it materially worse than the status quo, which is a strong statement considering Coinbase is one of the biggest crypto exchanges in the U.S. This decision triggered the postponement of the Senate markup vote and caused a ripple effect across the industry. Let's break down what Coinbase objects to. First, the bill reduces the authority of the CFTC, which is the Commodity Futures Trading Commission, over crypto regulations. The crypto community has long argued that the CFTC is better suited to handle digital assets because it has more experience with derivatives and flexible regulatory approaches. On the other hand, the SEC's involvement in crypto has often been seen as unpredictable, especially when it comes to classifying tokens as securities. The Clarity Act, as written, limits CFTC oversight and hands more regulatory power to the SEC, which could slow down innovation and create legal uncertainty for crypto businesses. Second, the bill limits rewards and interest offerings on exchanges. Normally, platforms like Coinbase and Uphold allow users to earn yields on stable coins, sometimes up to 3%, while traditional banks only offer 0.01% in savings accounts. This is not just about numbers, it's about competition. Banks fear losing deposits if users move their money to crypto platforms for higher returns. The Clarity Act tries to prevent crypto companies from offering competitive yields, which would protect banks' profits but hinder the growth of DeFi, decentralized finance, and user-friendly innovation. Third, there are restrictions on DeFi and tokenized assets. Certain clauses in the bill could prevent the growth of tokenized real-world assets in the US, which is critical for the next phase of blockchain finance. Tokenization allows everything from real estate to stocks to be represented on the blockchain, enabling faster, cheaper, and more transparent trading. Limiting this technology in America while other countries like China move forward with interest-bearing digital currencies puts the US crypto ecosystem at a disadvantage. Now the fallout. Coinbase's withdrawal sent shockwaves through Capitol Hill. Senators were forced to postpone the markup vote, and discussions about the bill are now more intense than ever. Brad Garlinghouse, Ripple's CEO, commented that Coinbase raised fair concerns and emphasized the need for constructive collaboration. However, public sentiment has been overwhelmingly negative because retail investors fear being left behind if restrictive measures are implemented. Here's an important point. This isn't just a regulatory debate, it's a power struggle. Big banks, the American Bankers Association, and community banking councils are lobbying heavily to protect their interests. They argue that allowing stablecoins to pay competitive yields would drain deposits from traditional banks, reducing their lending capacity. On the other hand, crypto companies argue that limiting yields and innovation is anti-competitive and harms everyday users who could benefit from fair returns. For investors, the takeaway is clear. The Clarity Act in its current form could stifle growth and limit access to innovative financial products. Coinbase's withdrawal is a warning sign. Even major crypto companies are wary of regulatory overreach that could damage the market. And while senators like Tim Scott and Cynthia Lummis are committed to bipartisan negotiations, the path to a fair and balanced bill will take time and careful adjustments. So, Cosmic Fam, here's a question for you. If you had to choose between keeping your money in a bank at 0.01% interest or a stablecoin earning 3%, which would you pick? This debate is exactly why the Clarity Act has become such a hot topic. The decisions made in Congress will directly affect your financial freedom, your crypto holdings, and the future of blockchain innovation in America. Now, let's dive into the banking side of the story. This is where things get really interesting because understanding the bank's perspective explains why this bill is such a mess and why your crypto investments could be affected. Banks in the United States are extremely concerned about stablecoins paying competitive yields. Think about it. Your average bank savings account might pay 0.01% interest, while crypto platforms like Coinbase or Uphold can offer around 3% on stablecoins. That's a huge gap. If users start moving their money from traditional banks to crypto platforms to earn higher returns, banks lose deposits, which directly impacts their lending capacity. This isn't just hypothetical. The Kansas City Fed calculated that if stablecoins paid competitive rates, banks could lose up to 25.9% of deposits, which is roughly $1.5 trillion in lending capacity. That's enough to seriously disrupt small and medium-sized businesses that rely on bank loans. So what did the banks do? They didn't innovate or compete with better rates. Instead, they wrote legislation. The Clarity Act, as currently drafted, effectively prohibits any stablecoin yield mechanisms, whether directly from issuers, exchanges, affiliates, or partners. In other words, every legal path for crypto companies to offer competitive returns is closed by statute. This is a classic example of regulatory capture, the incumbents writing the rules to protect themselves rather than letting markets compete fairly. Let's get into the key players. The American Bankers Association, 52 state banking associations, and the Community Banks Council all coordinated to influence this bill. They submitted lobbying letters to Congress outlining their concerns about stablecoin yields. From their perspective, allowing competitive returns in crypto creates a parallel banking system which threatens the stability and profitability of traditional banks. Essentially, they want to protect their deposits at all costs, even if it means stifling innovation in the U.S. financial system. The math behind their panic is simple but powerful. Stablecoin issuers can invest in short-term treasury bills, earning around 4.5%. If they pass that yield to users, retail investors naturally prefer crypto platforms over banks offering near zero rates. Banks cannot compete without risking huge losses, so their solution was legislation, not competition. The Clarity Act reflects this approach, essentially locking out fair competition from digital assets. This has huge implications for retail investors. If this bill passes in its current form, it limits your ability to earn fair returns on your crypto holdings, discourages innovation in DeFi, and slows down the growth of tokenized assets in the U.S. Meanwhile, countries like China are already moving forward with interest-bearing digital currencies, meaning the U.S. could fall behind in the global digital finance race. Brad Garlinghouse, Ripple's CEO, noted that the Clarity Act delay gives the industry a chance to work constructively with lawmakers, but it also highlights a key point. The current draft heavily favors banks over crypto companies and users. This isn't just a regulatory disagreement. It's a battle over the future of money, finance, and innovation in the U.S. So, Cosmic community, here's the takeaway. The banking lobby is powerful, and their influence is why the Clarity Act is so restrictive. They are trying to eliminate competition from crypto platforms rather than adapt to the innovation happening in the market. As an investor, it's critical to understand these forces because they directly affect yields, access to DeFi products, and the long-term growth of the crypto ecosystem in America. Let's focus on how this bill could directly impact DeFi users' tokenized assets and your financial privacy. This is where the stakes get really personal for anyone holding or using crypto in the US. First, let's talk about DeFi, or decentralized finance. DeFi platforms allow users to lend, borrow, and earn yields without relying on traditional banks. They are the backbone of financial innovation in crypto. However, the Clarity Act, in its current draft, imposes heavy restrictions on DeFi platforms. It increases compliance obligations, requires more reporting, and could even expose users' activities to real-time monitoring by regulators. Essentially, the bill transforms DeFi from a permissionless, user-driven ecosystem into a highly regulated, centralized framework. Why does this matter? For everyday investors, it means less freedom and fewer opportunities. DeFi users may no longer be able to earn competitive yields, access certain smart contracts, or participate in innovative financial products without facing legal restrictions. In other words, what was once an open playground for crypto innovation could become a regulated environment favoring large banks and established institutions, not retail investors. Next, let's discuss privacy concerns, which are often overlooked. Analysts like Paul Barron have called the Clarity Act a dragnet, highlighting that it could allow warrantless, real-time monitoring of all transactions. This isn't just theoretical. The bill gives regulators powers to track every movement in crypto networks, potentially freezing assets based on perceived risks, not proven crimes. In effect, it undermines financial privacy, a fundamental principle of digital currency, and could expose users to unnecessary scrutiny. The bill also restricts tokenized real-world assets, which are essential for the next stage of blockchain adoption. Tokenization allows everything from real estate to stocks to be represented on-chain, offering faster, cheaper, and more transparent trading. By limiting SEC authority to support tokenized assets, the Clarity Act could slow the adoption of this technology in the US, while countries like China move ahead with interest-bearing digital currencies. This could mean that America misses out on the innovation race entirely. The fallout from all of this is significant. Retail investors, the everyday people buying and using crypto, are likely to face the most negative impact. They could be locked out of earning fair yields, restricted from DeFi innovation, and monitored more closely than ever before. Meanwhile, large banks and incumbent financial institutions would continue to protect their profits and maintain dominance. The public reaction has been strong, with many on social platforms criticizing the bill for favoring big banks over crypto users. Brad Garlinghouse and Brian Armstrong are both actively engaging with lawmakers to address these issues. Armstrong's withdrawal from supporting the bill highlights the urgency. Even top crypto companies see the current draft as problematic and potentially harmful. Garlinghouse has emphasized that the industry still wants to work constructively, but it's clear that there are real risks if the bill passes in its current form. Cosmic community, the key takeaway is this. The Clarity Act is more than a regulatory update. It represents a turning point for U.S. crypto users, DeFi platforms, and the future of blockchain innovation. Understanding these restrictions and privacy risks is essential because they will directly affect how you invest, earn, and participate in digital finance. Now it's time to zoom out and look at the global picture. Why? Because while the U.S. debates restrictive legislation, other countries are moving forward aggressively with digital currencies and blockchain finance. If the Clarity Act passes as is, America could fall behind in the global crypto race. Let's start with China. On December 29th, China officially rolled out its interest-bearing digital yuan, ECNY. This means Chinese citizens can earn yields directly from the central bank on their digital currency holdings. Compare this to the U.S., where stablecoins could be legally blocked from offering competitive returns under the Clarity Act. From a financial innovation perspective, this is huge. China is creating an incentivized digital economy, while U.S. investors might be forced to settle for minimal returns through traditional banks. This contrast highlights the opportunity gap between the two nations. Why does this matter for U.S. investors? Well, yields aren't just about making extra money, they influence where capital flows. If stablecoins in the U.S. cannot compete with returns offered in other countries or by international platforms, investors may look abroad for better opportunities. This could slow the adoption of blockchain technology domestically and reduce U.S. influence in the global crypto ecosystem. Essentially, the Clarity Act could unintentionally hand innovation leadership to other countries, even as it claims to protect American consumers. Now let's consider long-term competitiveness. The U.S. has historically led in tech and financial innovation. But restrictive legislation like the Clarity Act could signal to entrepreneurs, developers, and investors that the U.S. is a challenging environment for crypto innovation. Tokenized assets, DeFi platforms, and yield-bearing products could all migrate offshore, reducing domestic investment and slowing growth in the U.S. digital finance market. Even Ripple CEO Brad Garlinghouse has emphasized that while the industry still wants constructive dialogue with lawmakers, the current draft contains provisions that risk slowing innovation and protecting incumbents rather than fostering fair competition. Coinbase's withdrawal shows that major crypto companies are taking this seriously. They see the draft as a threat to U.S. competitiveness, not a path to clarity. Another point to highlight is the timing issue. Even if the bill eventually passes, it will take months, possibly years, to implement, negotiate, and reconcile with other legislation. By that time, other countries may already have functional, incentivized digital financial systems. Meanwhile, U.S. users could face restricted yields, less innovation, and more surveillance, making the domestic crypto market less attractive for retail and institutional participants. Here's the takeaway for you, Cosmic family. The Clarity Act isn't just a U.S. regulatory issue, it's a global competitiveness issue. While lawmakers and industry leaders debate yields, oversight, and DeFi rules, the world is moving forward. If America wants to remain a leader in blockchain finance, these restrictions will need serious revision. Otherwise, the U.S. risks becoming a market where innovation is limited and investors have fewer opportunities compared to global alternatives. We've covered a lot so far: the Clarity Act delay, Coinbase and Ripple perspectives, banking influence, DeFi restrictions, privacy risks, and global comparisons. Now it's time to bring it all together and talk about what this means for you as a crypto investor and how to navigate the current U.S. regulatory landscape. First, let's recap the big picture. The Clarity Act was intended to provide clear rules for digital assets in the United States. In theory, this would help exchanges, DeFi platforms, and investors understand what's allowed and what isn't. In practice, the current draft has significant limitations. It restricts stablecoin yields, limits DeFi innovation, reduces CFTC oversight, and creates privacy concerns for users. Coinbase's withdrawal from supporting the bill highlights how serious these issues are, and it's why the Senate postponed the markup vote. Banks are a major factor here. They are protecting deposits and limiting competition by lobbying for restrictive rules. The math is simple. If stablecoins offer competitive yields, banks lose deposits and lending power. Their solution? Legislation that favors incumbents rather than innovation. This means the Clarity Act, as it currently stands, protects big banks but limits opportunities for everyday crypto users. For investors, the practical takeaway is this: the U.S. crypto market is in a period of uncertainty. Regulatory clarity might come eventually, but current drafts favor institutional interests over retail and innovation. This means that earning competitive yields on stablecoins or fully participating in DeFi could be more difficult for U.S. residents in the short term. That said, there are ways to navigate this uncertainty wisely. Stay informed, follow reliable crypto news sources, and watch how negotiations evolve. Changes can happen fast, and being informed helps you make smarter investment decisions. Diversify your holdings. Don't rely solely on US-based stablecoins or platforms. Explore international options cautiously, ensuring they are safe, regulated, and accessible. Understand risks. Know which platforms comply with US regulations and which may expose you to legal or financial risks. Privacy and security remain key considerations. Engage with the community. Public feedback matters. Many lawmakers pay attention to investor opinions, so discuss these issues in forums, social platforms, and community groups. Focus on long-term innovation. While regulations may slow down some yields or DeFi opportunities, the underlying blockchain technology continues to grow globally. Strategic long-term investments in reliable platforms and emerging tech could pay off even if US regulations are restrictive. Another point to remember is the global context. Countries like China are already implementing interest-bearing digital currencies, giving investors there clear advantages. The US could lag if restrictive rules persist. This is why industry leaders like Brian Armstrong and Brad Garlinghouse are pushing for constructive engagement with lawmakers to ensure innovation and fair competition remain possible domestically. In conclusion, Cosmic Family, the Clarity Act delay is both a warning and an opportunity. It highlights the influence of big banks, the potential risks to DeFi and tokenized assets, and the importance of staying proactive as a crypto investor. By staying informed, understanding the numbers behind stablecoin yields, and paying attention to global developments, you can navigate this uncertain period wisely and position yourself for success once regulatory clarity emerges. So here's my final question for you. Are you prepared for a US crypto landscape that may favor banks over innovation? Think carefully about your strategy, your platforms, and how you engage with this evolving ecosystem. And remember, knowledge is power. The more you understand these laws and debates, the better you can protect your assets and take advantage of opportunities. That's it for our deep dive into the Clarity Act, Coinbase objections, banking influence, DeFi, and the global context. If you found this series helpful, please like, share, and subscribe to We Are Cosmic. Stay tuned because I'll keep you updated with every major development in US crypto regulation, market moves, and blockchain innovation. Aloha, Cosmic community, and remember, stay curious, stay informed, and keep your crypto cosmic.